And PPNR this quarter, second quarter, is going to rise 16, 17% year over year. That will be its peak rate of growth year over year. And by the time we enter 27, it's going to slow to a mid-single digit rate of growth. And so if you think about PPNR, it's basically gross revenues minus operating expenses. It doesn't have any credit costs in there. And so as the rate of growth slows, you have less of a cushion to absorb rising credit costs. And I do believe the corporate credit cycle is going to get more strained as we move into 27. So essentially, if you think about it, you've got less cushion to absorb rising credit costs, which means your pre-tax income is going to grind to no growth. And that's why I think bank stocks have peaked in our sells here.
Yeah, I mean, XLF is near the highs right now, isn't it?
It is, and I did write about that. I mean, it's been led by the KRE, it's been led by the BKX, and, credit card stocks. Even insurance stocks have had a nice run in the last couple of weeks. But what hasn't done well have been these private equity, private credit names. Some of the exchange traded names like ICE, have not done well. CME have not done well. So you're seeing this sector rotation within financials as you are within the broader market. And there are certain groups that have done well, and there are certain groups that have continued to lag. I think banks are a sell here, even though they're trading close to their highs.
Yeah, I'm just looking at Apollo right now. It's at a rough 5 or 6 trading sessions in a row, 141, now it's at 115. Yeah, I just think that's right. I mean, when we think about these banks and you think about the private credit, like that flow through should be there, but it seems to not be there. What does it take it from, hey, these guys are struggling and this means something for the banks? Like, how does that mechanism work?
Well, the banks have the funding rails upon which private equity rides. In other words, the banks are a source of liquidity for private equity, private credit. And so if we do get significant, blow-ups in private equity, private credit, it's going to reverberate back to the banking industry. But we're probably 2 quarters away from that, becoming more visible. So it's more of a counterparty risk and a revenue risk in the sense that these financing rails are generating tremendous net interest income for the big bank. And if the banks, get nervous about their counterparty risk, they're going to pull those funding rails. And so you're going to get less growth in net interest income.
All right. Bob, you got anything else you're of interest this week?
Charlie, didn't one of these funds, I don't know if it's Paulo or somebody else, restricted redemptions? Is that going to be a signal at some point that sort of spins things, signals things are going awry if there are further gates on redemptions as people begin to panic or become
so they all had redemptions in the first quarter. Some limited it to the 5 cap, some of 100% of the requests. This quarter, it looks like everybody's limiting it to the 5%. And there have been a number of entities.